In 1769, a coin dealer in Frankfurt controlled a small money-changing business on Jew Street. By 1815, his 5 sons controlled the financial systems of England, France, Austria, Naples, and Prussia. By 1850, the family controlled more wealth than all the royal houses of Europe combined. Their name was Rothschild, and the banking system they built, the central banking model they created, the war financing mechanism they perfected, they didn't disappear when the gold standard collapsed. They evolved, they spread, and they control your life right now in 2025. The mortgage you pay, the national debt your taxes service, the interest rates that determine your purchasing power, the central banks that print your currency, every single one uses the Rothschild playbook, multi-generational wealth preservation through trusts, central bank monopolies on currency creation, financing both sides of conflicts to guarantee profit, and a network of intermarried banking families that coordinate policy across borders while remaining invisible to public scrutiny. In every century, a familiar architecture quietly takes shape. It begins with war, trade, or revolution, moments of instability that demand coordination beyond borders. Capital gathers where trust is scarce. Credit becomes more valuable than gold. Governments discover that power no longer rests only in territory or armies, but in access to liquidity. And somewhere within that shifting landscape, a network forms that understands the difference between owning wealth and controlling its flow. The pattern does not begin with domination, it begins with utility. In the late 18th century, a merchant banker in Frankfurt named Meyer Amschel Rothschild recognized something subtle about power. Kings borrowed, armies required financing before victory. Information moved slowly, but money could move faster if someone built the channels. He did not seek thrones, he sought relationships, contracts, settlement mechanisms, trust across borders in an era defined by distrust. His sons dispersed across Europe, London, Paris, Vienna, Naples, forming a private communications and capital network that functioned independently of any single state. By the time of the Napoleonic Wars, they were financing governments on opposing sides while maintaining internal cohesion. Their advantage was not ideology, it was infrastructure. As the 19th century advanced, sovereign debt markets matured. Bonds replaced plunder as the preferred tool of expansion. Governments that once raised funds through taxation alone now relied on international lenders. The ability to float debt in London or Paris became as decisive as battlefield strategy. Institutions such as the Bank of England operated within this ecosystem, but private houses often moved faster, absorbing risks states could not. The Rothschild name became synonymous with state finance, railway expansion, mining ventures, and gold flows between continents. They did not own Europe. They underwrote it. They did not command armies. They structured the credit that sustained them. And that distinction is the foundation of the pattern. Control in modern systems rarely announces itself. It embeds in plumbing, clearing houses, bond markets, correspondent banks, legal frameworks, currency pegs. Once embedded, it becomes difficult to distinguish from normalcy. The network is not visible because it is functional, it does not coerce, it conditions. Over time, influence compounds, relationships harden into expectations, governments rotate, ideologies shift, borders redraw themselves, but the mechanisms of settlement remain. The families and institutions that understand those mechanisms do not need spectacle. They require continuity. Every era believes its financial architecture is uniquely sophisticated. Every era assumes its safeguards are stronger than the last, yet the deeper pattern persists. When capital centralizes, sovereignty adjusts around it. The question is never who rules outright, it is who cannot be bypassed. When historians describe the fall of empires, they often focus on invasions, revolutions, or dramatic political events. But those moments are consequences, not causes. The first fracture appears in incentives. Production slows while promises expand. Debt rises not because leaders are reckless, but because the system quietly rewards postponement over discipline. Collapse in practice follows a progression that repeats across centuries. The first stage is consolidation. Capital concentrates in fewer hands because scale reduces risk. Larger institutions absorb smaller ones. Governments rely on those institutions for liquidity, especially during crises. The arrangement feels stabilizing. The second stage is dependency. Public finance becomes intertwined with private credit. States discover that access to borrowing allows them to spend beyond tax receipts without immediate pain. Markets accept this expansion because confidence remains intact. The third stage is distortion. Credit begins to allocate resources not toward productivity, but toward preservation. Weak enterprises survive because refinancing is easier than failure. Asset prices rise faster than output. Wealth appears abundant, yet underlying efficiency declines. The fourth stage is normalization. Practices that once signaled stress become routine. Extraordinary measures become permanent tools. The language of emergency turns into policy architecture. Risk is redefined as manageable. The fifth stage is fragility masked as strength. Because the system has functioned for decades, confidence deepens. Institutions grow larger, more interconnected, more indispensable. The cost of failure becomes unthinkable, which paradoxically makes failure systemic rather than isolated. The sixth stage is loss of trust. Not immediately, not dramatically, but incrementally. Investors demand higher compensation. Citizens question fairness. Foreign partners reconsider exposure. Trust erodes at the edges first, then at the center. The final stage is acceleration. What was gradual becomes sudden. Liquidity evaporates. Capital flees. Institutions that once appeared untouchable reveal their dependence on constant refinancing. Political consequences follow, but they follow financial contraction, not the other way around. This framework is not ideological, it is structural. Large financial houses, including networks such as the Rothschild banking system, thrived precisely because they understood these stages. They did not merely lend money, they anticipated when states would need it most. They positioned themselves at points of maximum dependency. They survived regime changes because they financed continuity. Collapse begins economically because economics governs incentives. Politics reacts to scarcity. Military conflict emerges from resource strain. But the imbalance originates in credit expansion relative to productive capacity. When a system relies more on confidence than on output, it becomes vulnerable to shifts in perception. And perception, unlike infrastructure, can change quickly. What makes the pattern enduring is that it does not require corruption or conspiracy. It requires only human preference for stability in the present over adjustment in the present. The stage is set long before anyone recognizes it, and history offers examples of how this progression unfolds when dominance appears permanent. In the early 19th century, Britain stood at the center of a financial universe it had helped construct. The United Kingdom possessed structural advantages few rivals could match. It commanded the seas, it industrialized earlier than its competitors. It established legal frameworks that protected contracts and property rights, and most importantly, it built a sovereign debt market that investors trusted. The City of London became the clearinghouse of global trade. Sterling-denominated bills of exchange circulated across continents. Insurance, shipping finance, and commodity settlement converged in one place. At the core of this machinery stood institutions such as the Bank of England, which coordinated liquidity during crises, and private banking families, among them the Rothschild network, who underwrote sovereign loans and stabilized gold flows. The British Empire did not expand solely through military superiority, it expanded through credit. Railways in Latin America, mining ventures in Africa, government bonds across Europe all found underwriting in London. Capital flowed outward, earning returns that reinforced Britain's financial dominance. But the very success of this system introduced subtle distortions. By the late 19th century, Britain was exporting capital at extraordinary rates. Rather than reinvesting domestically in emerging industries such as chemicals and electrical manufacturing, British wealth increasingly sought returns abroad. The empire consumed imported food and raw materials, financed by overseas income streams. Domestic productivity growth began to lag behind that of rising competitors like the Germany and the United States. Consumption remained high, financial sophistication deepened, but industrial discipline eroded. Debt accumulation was not reckless in the modern sense. Britain maintained credibility, yet the structure of its economy shifted toward financial intermediation rather than manufacturing output. The city flourished even as shipyards and factories faced increasing competition. Then came overextension. The costs of maintaining a global empire, military commitments, colonial administration, trade route security, strained public finances. When the First World War erupted, Britain suspended the gold standard and borrowed heavily, including from American banks. Sterling's supremacy depended on confidence, and war disrupted that confidence. After the war, Britain attempted to restore pre-war parity to sterling, a decision that imposed deflationary pressure on its economy. The financial architecture remained impressive, but the underlying productive base had weakened. The Great Depression accelerated the transition. By the time the Second World War concluded, Britain emerged victorious militarily, yet financially exhausted. The global reserve role shifted decisively toward the United States, and the dollar-based system institutionalized at Bretton Woods. Wealth had flowed through Britain for more than a century. It had financed the world, but increasingly, it did not remain anchored to domestic renewal. Financial centrality masked productive stagnation. The pattern was not dramatic until it was complete. Dominance gave way not to sudden collapse, but to gradual displacement. The infrastructure of global finance persisted, yet its gravitational center moved elsewhere. And once again, those who controlled the flow of capital adapted faster than the states that depended on it. At the dawn of the 20th century, confidence in permanence reached another peak. The industrial powers of continental Europe believed they had engineered a balance so sophisticated it could not fail. Capital moved freely between financial centers. Gold-anchored currencies, railways, telegraphs, and steamships compressed distance. Economists declared that large-scale war between advanced nations had become irrational because it would destroy shared prosperity. In the decades before 1914, cross-border lending surged. French investors financed Russian railways. German banks underwrote industrial expansion across Eastern Europe. London remained the clearinghouse, but Paris and Berlin operated with growing ambition. The gold standard was seen not merely as a monetary system, but as a civilizing constraint, an automatic stabilizer that prevented excess. This time, many believed discipline was embedded, yet beneath the confidence lay familiar stages. Capital concentration intensified. Large universal banks in Germany intertwined commercial and investment functions, amplifying both growth and risk. Governments relied on bond markets to fund naval expansion and colonial ventures. Debt issuance increased steadily, justified by strategic necessity and economic optimism. Normalization followed. Refinancing became routine. Industrial cartels stabilized prices. Political leaders interpreted market stability as proof of systemic resilience. Then came fragility masked as strength. The interlocking commitments that were meant to prevent conflict instead magnified it. Financial interdependence did not eliminate rivalry. It made its consequences systemic. When war erupted in 1914, gold convertibility was suspended almost immediately across Europe. Stock exchanges closed, cross-border payments froze. The belief that this time is different collapsed within weeks. After the war, policymakers attempted restoration. The gold standard returned in modified form during the 1920s, promoted as a return to discipline and normalcy. Yet underlying imbalances persisted. War debts and reparations created circular payment structures that depended on continuous American lending. The United States extended credit to Germany. Germany paid reparations to France and Britain. Britain and France serviced debts to the United States. It functioned until confidence faltered. When lending slowed at the end of the decade, the system seized. The Great Depression was not a failure of ambition. It was the unraveling of a structure built on continuous refinancing and mutual optimism. Denial persisted well into contraction. Policymakers defended fixed exchange rates and fiscal orthodoxy long after unemployment surged. Banks failed. International trade contracted sharply. Political consequences followed with devastating speed. The stages repeated under new conditions with more sophisticated institutions and greater intellectual assurance. Yet the outcome adhered to the same pattern defined earlier: dependency, distortion, normalization, fragility, loss of trust, acceleration. Financial networks survived, states fractured, And once again, those positioned at the nexus of capital flows adapted, restructured, and reemerged within a new architecture that promised permanence until the cycle resumed. In the modern era, the architecture is more complex, but the incentives are unchanged. After the Second World War, the global financial center shifted decisively to the United States. The Bretton Woods framework formalized dollar primacy, linking currencies to the dollar and the dollar to gold. Institutions such as the International Monetary Fund and the World Bank were established to stabilize imbalances and fund reconstruction. When the gold link was severed in 1971, the system did not collapse. It evolved. The dollar remained central not because of metallic backing, but because of network effects. Trade was invoiced in dollars, energy contracts cleared in dollars, sovereign reserves accumulated in dollar-denominated assets, depth and liquidity reinforced confidence. Within this ecosystem, global banking families, including the contemporary branches of the Rothschild network, no longer dominated sovereign finance as they had in the 19th century. Yet the broader principle endured. Those who structure capital flows shape outcomes. Investment banks, asset managers, and central banks now coordinate liquidity on a scale unimaginable to earlier eras. Public debt across advanced economies has expanded steadily for decades. Governments finance deficits through bond markets sustained by institutional demand. Central banks purchase assets to manage yields and ensure market functioning. Extraordinary measures introduced during crises often remain embedded afterward. Productivity growth in many advanced economies has slowed relative to earlier decades, even as asset prices have risen. Wealth has concentrated within financial markets. Consumption remains supported by credit expansion and low interest rates. None of this is inherently catastrophic. It reflects structural incentives. Elected officials prefer growth without contraction. Investors prefer liquidity without volatility. Central banks prefer stability without recession. Each actor responds rationally within the framework presented. But the pattern defined earlier becomes visible when incentives drift. When asset inflation outpaces wage growth, social cohesion strains. When debt servicing depends on low rates indefinitely, policy flexibility narrows. When institutions grow so large that failure becomes unacceptable, risk is absorbed centrally rather than distributed. Confidence remains high because the system has navigated repeated shocks, financial crises, pandemics, geopolitical tensions, without systemic breakdown. Each intervention reinforces the belief that collapse is improbable. Yet systems fail not when intentions deteriorate, but when incentive alignment erodes. If productivity does not sustain promises, promises accumulate faster than output. If confidence relies on perpetual accommodation, accommodation becomes structural rather than temporary. Modern finance is more digitized, more regulated, more interconnected than any predecessor. But interconnection magnifies fragility as efficiently as it magnifies growth. The Rothschild network adapted across centuries because it understood that financial power resides in continuity across regimes. Today's institutions operate under similar logic, though under different names and governance structures. The pattern does not depend on personalities. It depends on leverage, confidence, and the quiet assumption that refinancing will always be available. Late-stage systems rarely feel unstable. They feel sophisticated. Financial innovation accelerates. Risk models become more precise. Communication is instantaneous. Policymakers coordinate across borders with unprecedented speed. Volatility is dampened not by chance, but by intervention. Each crisis appears to validate the architecture because collapse is avoided. This is the acceleration phase. Institutions that once acted as lenders of last resort expand their mandates. Central banks move beyond traditional tools, purchasing sovereign bonds, corporate debt, even private assets. Balance sheets grow, yet the expansion is described as technical rather than structural. Temporary measures acquire permanence through repetition. Narrative control becomes subtle but pervasive. Market stability is framed as proof of resilience. Rising asset values are interpreted as signals of strength. Debt levels are contextualized against low interest rates. Risk is not denied, it is managed statistically. Warnings when they emerge are dismissed as misunderstanding complexity. Analysts who point to long-term imbalances are countered with data showing short-term stability. The system has weathered previous storms. Therefore, it will weather the next. Normalization deepens. Financial institutions grow more interconnected through derivatives, cross-holdings, and shared collateral frameworks. Liquidity depends on confidence in counterparties who themselves depend on continued liquidity. The structure is circular, but it functions until it does not. During this phase, incentives discourage preemptive correction. Reducing leverage risks slowing growth. Tightening credit risks asset deflation. Allowing failure risks contagion. Every option carries visible cost in the present, while imbalances appear abstract and distant. So adjustment is deferred. Capital continues to flow through central nodes, major banks, clearing systems, asset managers, whose scale makes them indispensable. Influence does not require overt control. It requires being the channel through which others must operate. By the time deterioration becomes visible in economic contraction or political instability, the financial contraction has already begun. Liquidity thins quietly before headlines acknowledge strain. Counterparties pull back incrementally. Trust erodes in layers. Acceleration is not chaos at first, it is tightening. And when tightening reaches a threshold, actions that once stabilized the system begin to expose its dependency on constant support. History shows that this turning point feels sudden only in retrospect. In real time, it is described as temporary turbulence until confidence crosses an invisible line and cannot be restored with reassurance alone. Financial systems do not repeat because people conspire to repeat them. They repeat because incentives endure. Across centuries, from the merchant houses of Frankfurt to the bond markets of London, from the gold standard to digital clearing networks, the underlying structure remains recognizable. Capital seeks efficiency. States seek flexibility. Investors seek yield with minimal risk. Each objective is rational. Together they generate cycles. The story of the Rothschild banking system is not one of secret omnipotence. It is a study in positioning. Mayor Amschel Rothschild understood that power resided less in ownership than in intermediation. By placing his family at the junction points of sovereign borrowing, gold transfers, and cross-border communication, he embedded them within the operating system of European finance. As regimes changed and empires rose or declined, the network adapted because it did not depend on ideology. It depended on continuity of service. Governments needed financing regardless of political structure. Trade required settlement regardless of flag. The family's influence persisted not through spectacle, but through indispensability. Modern institutions function under similar principles, though dispersed across corporate structures and regulatory frameworks. No single family commands the global system today in the way 19th century banking houses once influenced sovereign finance. Yet the logic of control through intermediation endures. Systems centralize because centralization reduces friction. Over time, that efficiency creates dependency. Dependency reshapes sovereignty. Sovereignty adjusts its policies to maintain access to liquidity. The adjustment feels pragmatic, even necessary. Then the cycle tightens. When debt expands faster than productivity, when asset values rise faster than wages, when intervention replaces discipline as the primary stabilizer, fragility accumulates beneath stability. No single decision causes the turning point. It emerges from cumulative incentives. History does not repeat because individuals are malicious. It repeats because structures reward short-term continuity over long-term correction. Each generation inherits mechanisms designed for resilience, then extends them to avoid discomfort. The extension works until it does not. The family who built control did not escape this pattern. They operated within it, mastered it, and survived multiple iterations. The systems around them transformed. The incentives beneath them remained. We study these cycles not to assign blame, but to recognize structure. If you're watching for the first time, welcome to the Economy Club. This is where we study the forces that shape history and the patterns that quietly decide the future. Stay curious, stay grounded, and we'll see you in the next cycle.